Hello everyone and welcome back. My name is Greg Furman and this is the VantagePoint AI Market Outlook for the week of January the 13th, 2020. Now, to get started this week, again, we're going to begin with that very important US dollar index. We're coming off the non-farm payroll number. Not a great number, but not a bad number either. The U6 number moving in the right direction, but missed estimates on a number of other components, but still a relatively decent number. Now, we're looking at major resistance coming in at these verified zones. That's coming in at or about the 97.40 area. Until such time as we break through that particular area, the dollar is unlikely to make any gains. The dollar demand that I've talked about over these many years is usually around the end of the month into the first week of the new month, and then any demand for dollars usually dries up. Now, again, we look at the indicators from VantagePoint. Our predicted RSI is starting to turn down here. Our neural index is down. And again, we have very, very strong resistance here. We need a break of that area if we have any chance whatsoever of targeting the previous high of 98.08. Now, gold, again, having a very good week. Of course, not getting anywhere down below the key VantagePoint levels, and unable to even penetrate below the medium-term T-cross at 1547. Good strong buying here, even after the relief where there was basically no further aggression between the US and Iran. Not even that could push gold lower. So again, when we look at this, gold has broken the previous range. Unless we get back inside this particular range down at 1525, then it's unlikely gold would move lower, particularly when we come into a period of time during the month when, again, there is very little dollar demand here. And to be clear, gold could have gone the other way here very easily. If the conflict had have escalated, gold would easily be above 1620. But to start the week, gold very, very strong again. And then we're seeing some profit taking basically on the de-escalation, but I'm not convinced that's completely over yet. So until we get breakdown below the critical level, the T-cross long 1528, buying gold is still a very reasonable play. I think it's very unlikely we're going to move anywhere below 1500, at least next week anyway. Now, when we look at the equities coming under significant selling pressure to start the week, rebounding a little bit in the middle of the week, unable to close below that key VantagePoint levels. But to be perfectly clear here, it's very difficult to call the equity markets with these kind of conflicts going on. But after that non-farm payroll number, when we look at the direct intermarket correlation, the S&P 500 has largely been correlated, actually positively correlated to the dollar index. So if the dollar index comes under pressure next week, equities likely will also. But again, when we look at our key intraday pivot area, that level right now is coming in at or about the 32.54, 32.37 the yearly opening price. I would also watch that area very, very closely. If buyers come back in, we have the possibility of extending higher. But at this particular time, my optimism remains guarded. I think the equities have overshot the mark a little bit, but they still have room to extend. The indicators, you can see the predicted RSI starting to lose that momentum. Now, when we look at oil and the correlation to the equity markets, oil really taking a hit after the de-escalation, oil coming crashing back down. But this, guys, is why you never buy, you never buy any kind of financial asset based around news, because whenever this is the market reacting to US-Iran conflict, and the same move that drove it up is the same thing that drove it down. So you're just much like equities, you're guessing a little bit here because you're dependent on something outside of your control, meaning specifically what's going on between the US and Iran. So if things settle down there, oil will flatten out again. The equities will probably remain firm. But again, I will point out with equities too that whenever we've seen the kind of year that we saw in 2019 on the S&P 500, there's never been any significant follow through. It's actually the following year, after such an up year, not almost every year after that has basically moved lower, not higher. So I would be very cautious with buying oil and equities at this particular time. Now, when we move into our main Forex pairs, the Euro US, we can see that again, it's starting to stall down around this verified zone. I expected a little deeper pullback into the 110.66 area, but we can see that the market starting to stall here. We've got a yellow area of caution around that triple EMA cross. When we look at our long predicted, a very important intraday daily pivot area, that area coming in at 111.34, as soon as we get back up above that area, we're likely going to go higher. And again, we're in a period next week, the middle of next week, we should start seeing the dollar weaken. That's a normal course of action outside of all of this other noise with the US and Iran and everything else. It usually dollar demand drives up around the middle of the month. So we would look to potentially go long Euro US here, I think is a reasonable play. We've got our predicted differences starting to flatten out. The RSI is rising. The neural index has gone from red to green. So there's a number of different positives here. But this would also, if Euro US moves higher, the direct correlation there would be equities lower and gold higher. So those inner markets are indirectly supporting longs on the Euro, at least going into the middle of the month. Now, with US Swiss franc, again, we've got a busy week ahead of us, but again, we've got to break through this 97.52. We're banging up against this level, and we just can't seem to get through it. We're losing momentum on the RSI. We're at 49.8. If we can break through 97.52, but we're going to need a global risk-on environment to get this thing moving higher. The clear downtrend on this, if we look at this particular pair, despite the big rise in equity markets, pretty solid downtrend here, but also very powerful support down to the 96.59. So shorts are very, very risky down at this particular level unless we get a sustained break of 96.59. Now, if the dollar weakens during the course of the middle of the week, then we would see the pound dollar start to rise. I would watch very closely this verified support zone that we're sitting on right now at 130.53. We have additional very powerful support at 129.05, but the market again is very choppy and very sideways. We're coming off the first trading week of the year and a very, very volatile one at that. So we want to be cautious if we're looking at longs. I would let this one settle down for a couple of days. Tuesday, Wednesday, I think we should see this thing reverse and start moving higher looking at the VantagePoint indicators. But again, we also have some very powerful verified resistance. The first one coming in at 132.12, our secondary level coming in at 132.84, and of course a major level at, again, this high coming in at 135.14. But we need to hold in this lower area if this pair has any chance of moving higher. Now, with the dollar yen for next week, the first thing I want to point out here, guys, the market again, as I had said last week, this is a blip in the bar chart data. Dollar yen did not trade to 111.12, to be very clear. We have been unable to break through the current verified resistance zone at 109.68. Only a sustained break of 109.68 will take the pressure off the downside, in my respectful opinion. And if equities are getting ready to turn lower, then dollar yen is going to follow lower. That's the way this works, guys, with the intermarket correlations. We've had a nice corrective move off of here. Dollar yen, probably one of the most volatile pairs last week. You can see this is a single bar day here. We went all the way down to 107.68 and then skyrocketed right back up to 109.24, but we haven't penetrated through this resistance zone. So until such time as that happens, shorts are clearly favored. Now, again, with US Canada, we've had a good recovery, as I talked about last week, but we still cannot break through this key vantage point level at 130.74. Only a sustained break of 130.74 will, again, take the pressure off the downside. So if equities start to move lower and oil continues to move lower, US Canada will go higher. If we look at the vantage point predicted moving average, again, using 31 other correlated markets, we can see that we broke above that key level. I guess on January the 8th, we've got a high there of 130.43, clearing the 130.21 area, and up we go. Now, the Canadian labor report was pretty decent. The U.S. not so much, but, you know, again, the U6 number on the U.S. unemployment number was still okay. Canada was better than expected, but still, I think there's a better chance of Canada going into a recession than the U.S. So longs favored, but again, longs are favored while we hold above this key support level, which comes in at 129.44. Now, if the equity markets turn lower, that could be a positive for Aussie US and New Zealand US. Now, we've got good support that's formed this week, but again, we already had verified support at 68.38. We came close to that area, and you can see that the buyers stepped in 3-4 days in a row, but they again cannot penetrate that key vantage point level at 69.11. If we can take out 69.11, this pair is likely going to go higher. If we click on our F8 in our software, our key intraday pivot area, it looks like it's flattening out, and it could be getting ready to turn higher. Our neural indexes turn green. Our medium term crossing our long term predicted difference appears imminent at this particular time. So again, longs favored here, guys, while we're holding above our current low of 68.38. Now, with our final pair, again, with New Zealand US, when we look at New Zealand US, you can see that we've got support forming here. If we just visually look at that and say, okay, we're going to draw a line there. If we can hold above this particular area, once again, the Vantage Point indicators are warning that this pair is getting ready to go higher. The neural index, the rising RSI, medium term crossing the long term predicted difference, looks like we're getting ready to turn around. If we click on, again, our F8, the problem is the Vantage Point, again, are long predicted. We can't seem to get above this thing. Very good shorts, though. Again, when we look at this, when we talked in last week's Forex Weekly Outlook that we anticipated dollar strength this week, but now we're anticipating dollar weakness on a lack of demand. Not really for economic reasons, just lack of real world demand for dollars next week, or so these are the things we want to monitor when we're trading the Forex market, and make sure we're looking at our direct intermarket correlations. So with that said, this is the Vantage Point AI Market Outlook for the week of January the 13th, 2020.